If I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
Hey guys, what's up? Welcome back to the Impeccable Investor. The Standard & Poor's 500 Index, also known as the S&P 500 Index, is a stock market index of the 500 largest publicly traded companies of the U.S. It reports on the stock market's performance and the risks and returns of the biggest companies in the country, and is used as the overall market benchmark by investors to compare other investments. It's widely regarded as the best gauge of large-cap U.S. equities. So without further ado, let's dive into our analysis of the S&P 500 Index. S&P 500 weighting formula and calculation. Unlike the DJIA with price-weighted index, the S&P 500 Index uses a market capitalization weighting method, which gives a higher percentage allocation to those companies that have the largest market capitalizations. It calculates as company weighting in S&P 500 equals company market cap / total of all market caps. To get the market capitalization of a company, the current stock price is multiplied by the number of outstanding shares. Construction of S&P 500. S&P 500 Index uses only free-floating shares, i.e., shares that can be traded by the public. Each company's market capitalizations is adjusted to compensate for any company mergers and new share issues. However, the divisor in the weighting formula is confidential information of the S&P that is not made available to the public. Still, a company's weighting can be calculated, which provides the investor with useful information and helps to get a sense of how a stock rise or fall might affect the overall index. A company, for example, with a 3% weighting will have a smaller impact on the value of the index than a company with a weighting of 8%. Index SPX plus 0.39%, starting off with Index SPX plus 0.39%, a combination of growth stocks and value stocks, which is the bedrock of many people's portfolios. In late March of 2020, the Standard & Poor's 500 Index, SPX plus 0.39%, was trading around 2,200 points, and the indication is quite evident. Like it was anticipated earlier, a recovery toward 3,000 points for the S&P 500 Index will be made over the coming months. The S&P 500 on the 29th of April 2020 made it up to 2,954 points, and the upside had started looking a lot less attractive. Besides the upside becoming less attractive, the available evidence about what's probably going to happen next has also become more and more conflicting. Support. For the Standard & Poor's 500 Index, the best scenario for now is to test support at 2,500 to 2,600 before going any higher. For the SPDR, S&P 500 Trust, SPY plus 0.46%, the corresponding support is at around 250 to 260. For the Dow Jones Industrial Average, DJIA, plus 0.25%, support ranges from 22,500 to 21,500, and between 213 to 226 for the SPDR Dow Jones Industrial Average Trust. DIA plus 0.26% for the NASDAQ Composite. COMP plus 0.79% support is about 8,000, and for the Invesco QQQ Trust, QQQ plus 0.64%, it is round about 192. If these levels are reached, they'll help bounce the prices higher. Sentiments of the option traders. The Chicago Board Options Exchange, or CBOE, equity put or call ratio calculates the number of bullish call options that are bought and compares it to the bearish put options, where higher readings are a sign of fear, while lower readings are a sign of being complacent. The 10-day SMA, or Simple Moving Average, on the 11th of May 2020, of the CBOE equity put-call ratio fell lower than 0.60 after rising above 0.98 in March 2020. A shift this big has never been seen before. Although in May of 2008 and January of 2009, the ratio did plunge from being above 0.97 to then going down below 0.63. Both of these times coincided with the close of bear market rallies. On the 11th of May 2020, the S&P 500 index came to a close at 6.85%, which was above its 50-day SMA, but still it was 2.43% below the S&P 500's 200-day SMA. It is not often that you get to see this much of a divergence. Ever since the 1970s, there have been only 8 other occurrences where the S&P 500 index was over 6.8%, more than its 50-day SMA, while also being more than 2% below its 50-day SMA. The S&P 500 index was down about 5 times a month later. However, what's more concerning about the situation is that the closest cases to this, which occurred in May as well as November 2011, both ended up leading the way to further losses. What to expect next? Given the current situation, evidence is not as conclusive as it has been earlier, but unless the major indices break above their May highs, it can be expected that more weakness may take hold from 18 to 22 of May 2020. It would be a good idea to buy stocks back again after a pullback of around 10%. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also, watch the 2 videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.